Welcome to this custom deep dive. We're so glad to have you with us today. Because, well, right now, the world's most powerful central bankers and financial leaders they are absolutely terrified of a number they can't even see.
Yeah, it's a completely invisible theoretical interest rate, but they are practically tearing their hair out trying to locate it.
Exactly. And our mission today is to demystify a highly exclusive briefing document. It's called the Global Review by Farid Novin, and it was prepared specifically for the G7 Évian Summit that's happening literally this month, June 2026.
Right, and reading through this briefing, you can really feel the underlying tension. I mean, for years, basically since the 2008 financial crisis, the entire global economy got very, very comfortable with a specific reality.
Which is that capital was practically free.
Exactly. Borrowing money was incredibly cheap. But reading the room heading into Evian, there is this massive structural debate that's just fracturing these institutions. They are desperately trying to figure out if the era of cheap money has ended permanently, or, if 2026 is just a messy, temporary blip.
Before we get deep into the weeds here, let's establish why you, listening to this right now, should care. This isn't just academic jargon. This theoretical number they're hunting for is called R star.
R star, yeah.
And the location of R star is the gravitational pull for your entire financial life. It dictates the cost of your mortgage, it dictates the interest rate on a small business loan.
Oh, absolutely.
And it ultimately decides whether the global economy is heading for a roaring boom or a recession. Okay, let's unpack this. What exactly is R star and why is it invisible?
Well, think of R star as the Goldilocks interest rate. It is the perfect, neutral, real interest rate that keeps an economy chugging along at full employment without, accidentally sparking inflation.
Right.
If a central bank sets their actual everyday interest rate above R star, they are actively hitting the brakes on the economy.
Well,
if they set it below R star, they are stepping on the gas.
So it's basically like driving on a highway where the speed limit signs are totally blank, and the central bankers are the ones behind the wheel.
That's a great way to look at it.
If they drive too fast, we crash into inflation. If they drive too slow, the car stalls and we get a recession. But they don't actually know what the speed limit is at any given moment.
That captures the dilemma perfectly. And the reason they're panicking right now is that the speedometer on their dashboard, it's giving them wildly conflicting readings.
How so?
Well, they use incredibly complex economic models to estimate where Y star is, but those models are deeply divided. Take the New York Fed. They use a very famous model called the HLW model.
The Holston-Laubach-Williams model, right?
Yes, exactly. And that model looks at the data and concludes that the real neutral rate is still sitting below 1%. It's telling them the speed limit is very low. But if you look at market-implied signals, the story completely flips.
Right. The report specifically mentions TIPS, Treasury Inflation-Protected Securities, which, for the listener, is essentially the bond market betting real money on where inflation and rates are heading. And those market signals are putting the neutral rate above 3%. That is a massive chasm. I mean, the academic model says one thing, but the people putting real money on the line say another.
It's a huge gap, and it's causing serious internal division, even within the Federal Reserve itself. Every quarter, the Fed's policy committee members release their own individual projections for where they think rates should be long term.
The dots.
Yeah, financial nerds affectionately call them the dots. Right now, the median dot sits at 3.1% nominal.
Let me jump in really quickly to define that for you listening. When we say nominal, we mean the sticker price interest rate before you factor in inflation.
Right.
So if you subtract the Fed's 2% inflation target, that 3.1% nominal rate translates to roughly a 1.1% real interest rate.
Yeah.
Because real is what actually matters for your purchasing power.
Spot on. So the median real rate they project is around 1.1%. But if you look at the individual dots from the 19 committee members, there's a spread of well over 100 basis points among them.
Meaning a full percentage point difference.
Yes. A full percentage point. You have 19 of the top economic minds in the country sitting in the exact same room looking at the exact same data.
And they completely disagree on where neutral is.
Exactly. They are all over the map.
But wait, if all these multi-million-dollar economic models completely disagree, and the Fed officials themselves are all over the map, how can central banks possibly set policy right now?
That's the million-dollar question.
I mean, how do you drive the car if you don't even know if your instruments are working?
You have to fundamentally change your approach. You stop looking for a single precise number and you start thinking in terms of probabilities. So the briefing document introduces what it calls a Bayesian framework to handle this uncertainty.
A Bayesian framework meaning they aren't locking into one rigid number, but they're constantly updating their best guesses as new real-world data rolls in.
Exactly the right way to think about it. Because the single point estimates are broken, the report assigns probabilities to 4 different potential scenarios. Their base case, which they give a 45% probability, says that Rye has shifted up.
But only moderately, right?
Yes, structurally, but moderately. They estimate an updated real Rye of roughly 1.25 to 1.75%. So a bit higher than the cheap money era of the 2010s, but not skyrocketing.
Right.
And this is a massive, but the report highlights 3 major physical realities hitting in 2026 that are violently shaking up that base case.
And that brings us out of the realm of theoretical math and right into the physical world. Because the first major curveball disrupting all these delicate models is the unexpected outbreak of the Iran war in late February of this year.
Yeah, this is what economists call a classic brutal supply-side shock. The conflict immediately disrupted shipping through the Strait of Hormuz.
Which is critical.
Absolutely critical geography.
Yeah.
Approximately 20% of global oil trade transits through that specific choke point. We saw oil prices surge to $115 a barrel at the peak of the conflict.
Wow.
And even now, as of late May, with a fragile ceasefire technically in place, Brent crude is stubbornly hovering near $96 a barrel.
And the ripple effects of that hit the average consumer's wallet almost immediately. I mean, U.S. headline inflation rose back up to 3.8% in April. The OECD had to bump its G20 inflation forecast up to 4%.
It's completely derailing things.
The Dallas Fed ran the numbers and modeled that this could push headline inflation up considerably, even if the physical disruption only lasts a single quarter.
If we connect this to the bigger picture, supply shocks like this are central bankers' absolute worst nightmares.
Why is that?
Usually when an economy runs hot and inflation rises, it happens because demand is too high. People and companies have too much money chasing too few goods. Central banks know how to fix that. They raise interest rates to cool down the demand.
Right.
But a supply shock, like a massive spike in oil prices, shrinks what the economy can physically produce. While simultaneously making everything more expensive to transport and manufacture, it creates stagflation.
But usually, central banks try to look past temporary supply shocks, right? They assume a war or a pandemic or a hurricane will eventually pass and the supply chain will heal. Why is this specific oil shock completely derailing the G7's plans for rate cuts?
It comes down to terrible timing. This negative supply shock is landing at the exact same moment as a massive historic surge in demand.
Oh, I see.
Yeah, central banks are facing a simultaneous reduction in what the economy can produce, driven by the oil shock, and an enormous, almost unprecedented increase in what the economy is trying to spend. And that spending is entirely driven by the artificial intelligence boom.
Let's follow that demand surge, because this is the part of the report that really forced me to change how I think about technology and the economy. The document highlights a landmark speech given by Chicago Fed President Austin Goolsbee in Tokyo on May 27, 2026.
Yes, that was a pivotal speech.
He introduces what we can call the AI paradox.
Goolsbee's theorem is brilliant because it challenges the conventional wisdom of the entire tech sector. To understand it, you first have to look at the sheer volume of capital flowing into AI right now.
It's staggering.
It really is. U.S. hyperscalers, those massive tech giants building the actual physical data centers and cloud infrastructure, they're currently spending $400 billion on AI capital expenditure. Now, there is a prevailing view in Washington, which the document calls the Warsh Treasury view, that says all this AI investment is perfectly fine. They argue it's exactly like the 1990s tech boom.
Right, the classic 90s narrative goes like this. You invest in new technology, and that technology makes workers way more productive. We can suddenly do more with less effort.
Exactly.
That means the overall supply of goods and services expands, which actually drives prices down and lowers inflation. So following that logic, if AI lowers inflation by making us hyper-productive, central banks should actually be cutting interest rates to support the boom.
That is the standard narrative you hear on financial television every single day. But Goolsbee argues that comparing AI to the 1990s internet boom is fundamentally flawed.
Why?
He points out a crucial structural difference. Back in the 90s, the productivity gains were largely a surprise. Businesses adopted computers, and suddenly the economy was operating much more efficiently before anyone had fully priced that massive windfall into the stock market or into their spending habits.
Wow, yeah.
Because the productivity arrived first, it was genuinely disinflationary. But today, with AI, the productivity isn't a surprise at all. It is the most highly anticipated economic event in human history.
Here's where it gets really interesting. Everyone expects AI to make companies insanely profitable 5 or 10 years from now. So stock markets are booming today based on those future expectations.
Exactly.
Companies are spending hundreds of billions of dollars constructing data centers and securing power grids today. It's like knowing you won the lottery, so you go out and buy a Ferrari today, but the lottery commission hasn't actually mailed you the check yet. You're creating massive demand with money that doesn't technically exist yet.
That is the AI paradox perfectly illustrated. This anticipation creates a massive wealth effect before a single drop of actual productivity has been realized by the broader economy.
Wild.
And Goolsby's policy implication from this paradox is stark. If AI expectations are creating a massive surge in demand today, then near-term interest rates cannot be cut. They have to stay high. They might even need to go higher to prevent the economy from overheating before the AI actually arrives to help ease the burden.
Wow. So we have an oil shock causing inflation on the supply side, and AI hype causing a spending frenzy on the demand side. The people tasked with managing this collision are the central bankers. But right in the middle of this chaos, the Federal Reserve is undergoing a massive leadership change. Which brings us to the third curveball.
Yes, the institutional drama. In May 2026, Kevin Warsh replaces Jerome Powell as Fed chair, and he was confirmed by a 54-45 Senate vote.
That is incredibly tight.
To put that in perspective, that is the narrowest confirmation margin in the history of the Federal Reserve. And the April FOMC meeting, right before he took over, was the most fractured in 3 decades, with 4 dissenting votes.
I want to pause here to address the political context highlighted in the source. And I want to be perfectly clear to you listening, we are impartially reporting on the economic tensions laid out in this document. We are not taking any political sides or endorsing any administration's view. We're just examining the structural reality presented in the text.
Of course.
The report points out a profound irony. The Trump administration consistently argued that interest rates were far too high and wanted cuts. But Warsh is stepping into an environment where U.S. fiscal deficits are running over 6% of GDP, inflation has risen back up to 3.8%, and based on Goolsby's AI paradox, rates might actually need to go up, not down.
Right, and he's inheriting a committee that is visibly fracturing under that exact pressure. You have some members insisting rates are already suffocating the economy, while internal models like the Cleveland Fed's Zeman model estimated with a 77% probability that policy was already in restrictive territory.
I have to push back a little on the premise here, though. Central banks in the G7 are explicitly designed to be independent of politics. The math should just be the math. Why does a narrow Senate vote or internal committee arguments actually change the Rye-Star probabilities in a serious economic report?
This raises an important question. It's because economic math ultimately relies on human trust. The report outlines a concept called fiscal dominance, which is scenario 5th in their framework.
Okay.
The probability of this specific tail risk scenario just jumped to 12%. Fiscal dominance happens when financial markets look at a central bank and lose faith in its ability to navigate political pressure, massive government deficits, and its own internal divisions.
So if the bond market thinks the central bank might buckle under political pressure and let inflation run hot to make it easier for the government to pay off its debts, the market preemptively reacts.
Exactly. When trust in the institution breaks down, investors demand a risk premium. They essentially tell the government, if I am going to lend you money for 10 years and I don't trust your central bank to keep inflation under control, I need a much higher interest rate up front to compensate me for that risk.
So it mathematically forces borrowing costs higher for everyone across the board.
Yes. From the federal government down to a family getting a mortgage, regardless of what the academic models say the theoretical neutral rate should be.
That makes total sense, even if it is a bit unsettling. So if the U.S. situation is this volatile, how is the rest of the world handling this? Because the briefing outlines a pretty stark global divergence heading into the Évian Summit.
Oh, the G7 is certainly not moving in lockstep right now. If we do a quick world tour, we have to start with the euro area. The European Central Bank has held rates at 2.0%. Why are they lower than the U.S.? Because they are getting hit much harder by the Iran energy shock. Europe imports a vastly higher share of its energy than the U.S. does. At the same time, Germany is boosting capital investment by 20% trying to get out of an industrial slump.
And then you look at the UK. The Bank of England is sitting at 3.75%. Their struggle is unique. They're dealing with exceptionally weak worker productivity and digesting high taxes from their 2025 autumn budget.
Exactly. And then there is Japan, which is a fascinating outlier. The Bank of Japan is currently sitting at a policy rate of just 0.75%.
Wow, still that low.
Yeah, but after literally decades of fighting deflation, they are finally waking up. The Iran shock forced them to sharply revise their core inflation forecast upward to 2.8%. Japan is the real-world embodiment of Scenario I in the report's secular stagnation. They prove that once an economy gets stuck in a low-growth demographic trap, escaping is incredibly difficult.
And wrapping up the tour, we can't forget Canada. Canada arrives at the Évian Summit led by Prime Minister Mark Carney, which is structurally so ironic. You have a prime minister who literally used to run the Bank of Canada and the Bank of England.
Right.
He knows the central banking playbook better than anyone. But looking at this whole tour, Japan at 0.75, Europe at 2, the U.S. at 3.75 with massive deficits. If every country has completely different demographics, energy needs, and fiscal policies, why do they even bother coordinating at the G7s? Can't they just set their own neutral rates?
They absolutely cannot ignore each other. This is the crux of the Évian Summit managing global macro imbalances. Global capital is interconnected. It's essentially one giant planetary pool of money constantly seeking the best return.
I see.
You have Chinese corporate savings, massive U.S. government deficits, and European industrial underinvestment all sloshing together. If the U.S. is offering much higher interest rates because of its 6% deficits and AI boom, capital from Europe and Japan will naturally flood into the U.S. to capture those yields.
Meaning if they don't coordinate, the pressure builds up until currency markets literally break.
Precisely. If capital flees Europe for the U.S., the euro collapses against the dollar. A weak euro means everything Europe imports suddenly becomes drastically more expensive, which imports massive inflation. They have to coordinate.
So what does this all mean? Let's distill all of this down for you, the listener. The absolute bottom line from this deep dive into the G7 briefing document is that the era of costless capital is heavily interrupted, if not completely over.
Without a doubt.
The updated base case estimates that the U.S. posterior real R-star is now sitting around 1.45 to 1.70%. The academic models are broken, the Federal Reserve is fractured, and geopolitical supply shocks are making a mess of the data. AI might ultimately save the economy, but only if the hype doesn't burn it down first.
It is a razor-thin tightrope the G7 is walking right now.
I want to leave you with one final provocative thought to mull over as you go about your day. Goolsby's entire warning rests on the gap between anticipating AI productivity and actually getting it. The stock market is booming today because we expect AI to make us insanely efficient tomorrow.
Right.
But what happens if the AI dividend takes 10 years to actually arrive? Financial markets and global governments have already spent the money today. Are we currently setting ourselves up for the biggest economic whiplash of our lifetimes when the Ferrari bill comes due, but the lottery check is still in the mail?
It is the multi-trillion-dollar question that Évian has to answer.
Thank you for joining us on this custom deep dive into the invisible forces shaping our world. Keep questioning the consensus, and we'll see you next time.